my name is Mary Stoner, and for Dr. Cresson's Finance 381 class, we were to analyze 3 companies in order to choose which companies as a bank we would lend a short-term loan to, a long-term loan to, and which company we would buy 50% of. We were obligated to choose one company, but no more than 2, in order to rank the companies from which we thought would be the best choice for the loan or for the purchase. The 3 companies that I chose were Hornbeck, Starbucks, and Keurig. Hornbeck Offshore Services is in the oil and gas industry, and Starbucks and Keurig are both in the specialty coffee industry. Hornbeck Offshore Services provides transportation for the oil and gas, and they also own some tugboats and barges in northeastern United States. Starbucks Corporation, which I'm sure everyone is very familiar with, is a worldwide company that retails, roasts, and provides its own brand of specialty coffees. And they also sell bottled coffee drinks and have their own line of ice cream. Keurig Green Mountain Incorporated, also known as just Keurig, is a specialty coffee and coffee maker business. They make the single cup brewers, and they also sell the single cups to make the coffee. In order to make a short-term loan, we are to analyze these 3 ratios: the current ratio, quick ratio, and cash ratio. The current ratio measures the current assets over the company's current obligations. The quick ratio is basically the same thing, except we subtract inventory because you cannot pay your bills with inventory unless it's sold. And the cash ratio, which is the cash the company has on hand at that time in order to pay their obligations. The current ratio of the 3 companies. Here's Hornbeck at the top. It is a very volatile company. It moves with the industry, which is very volatile as well. From 2009 to 2011, there's a dramatic increase. It decreases in 2012, and it fades off from 2013, an increase, and again a decrease. Keurig is the second highest in numbers. From 2009 to 2010, it decreases, but there's a slow increase since then. So the company figured out the issue and fixed it. And Starbucks is the lowest in numbers for the current ratio, which means their current assets to liabilities are not as big of a difference. The quick ratio of the 3 companies. Hornbeck again is very volatile here at the top. Keurig falls below Starbucks here, which means that their inventory affects their assets more than Starbucks does, because here's Starbucks with a pretty steady increase from 2012, a decrease in 2013, and again increasing in 2014. The cash ratio for the companies fall a little bit closer together, which means they all have a pretty good amount of cash in order to cover their short-term obligations. Here is Keurig actually at the top here, increasing from 2010 to 2011, decreasing in 2012, and all of them pretty much move in the same direction here. Hornbeck is the lowest on the cash ratio. Although Hornbeck is the lowest cash ratio, it is cash, which means that they still have cash available in order to cover their obligations. And the difference between Hornbeck and Starbucks, and Keurig is Hornbeck, their inventory does not affect their assets significantly. So in order for their short-term obligations to be paid, they don't have to sell inventory in order to cover their obligations. These numbers are pretty high, so as a bank, I am confident that they can pay me back a short-term loan. In order to give a long-term loan, we are to analyze the equity multiplier and the time interest earned of the companies. The equity multiplier measures the assets, the total assets over the total equity of the company. And the times interest earned measures the income from operations over their interest expense, which is their operating income to cover total interest. The equity multiplier of the three companies, we have Hornbeck here at the top. It's it's in between $2 and $2.50 per dollar. So for every dollar in equity, they're earning about $2.25 from assets. They have about $2.25 in assets throughout 2009 to 2014. In Starbucks, here is the second line. It's decreasing from 2009 to 2012, and then in 2013, from 2012 to 2014, it's increasing dramatically, and actually surpasses Hornbeck. Keurig down here increases from 2009 to 2011, and then slowly decreases through 2014, which means that their total assets to equity ratio starts to fall off. The times interest earned ratio for the three companies, we have Starbucks, which is increasing dramatically from 2009 to 2012, and then 2013 they made some very big business decisions, which I will talk about in a minute, which also allowed them to increase dramatically in 2014. And here we have Keurig, which is the second highest in numbers. Since 2011, they've been increasing dramatically from the operating income to interest expense. So this graph shows that they're very able to cover their interest expenses through their operating income, which is a good sign for a successful company. Here we have Hornbeck down here. From 2009 to 2012, it's increasing, and then again falls off after 2012, and that's due to the industry. The first company that I would give a long-term loan to would be Starbucks. Their equity multiplier never falls below 1, which means that their asset dollar to equity dollar is always greater than 1, which is a good sign. They're using their money from the equity efficiently. And their times interest earned ratio is always very, very high, which means their operating income to cover their interest expense is absolutely wonderful. They have great operating income, which means that the bank is confident that Starbucks could pay back a long-term loan very easily. In 2013, the reason for this large fluctuation is Starbucks made a business decision to close a lot of stores and make the company more efficient with the stores that they already have. There was a recession in 2013, if you can remember, and the company made this smart business decision, and they were able to continue through 2014. They were able to increase their numbers once again. Keurig, we have over here, that would be my second choice for a long-term loan. Their equity multiplier also never falls below 1, Their times interest earned ratio is very high and is steadily increasing. And once again, that is such an important ratio to me because the operating income to cover interest expenses, when the numbers are this high, I'm very, very confident that they can pay back the loan plus the interest on top of the loan. The third decision of the bank would be to buy 50% of a company, and the three ratios used to compare these companies are the return on equity, the return on assets, and the price to earnings ratio. The return on equity is the profit margin times the total asset turnover times the equity multiplier. We can also look at this as the net income over the stockholders' equity, which means I'm comparing the amount of income I'm getting to the amount of money that stockholders are putting into the company. The return on assets could be compared from the profit margin to times the total asset turnover, or the same as the return on equity, I can compare the net income over the assets. So what I'm making off of the assets that I own. And the price to earnings ratio is the market price per share of common stock over the earnings per share, which is what the market thinks my company is going to do over the original earnings. The return on equity for the three companies, we have Starbucks, which is at the top. Again, it falls in 2013, but these numbers just can't be overlooked. Keurig, we have down here from 2009 to 2014. For the most part, it's a pretty steady increase. In Hornbeck, we have this volatile industry. We have volatile numbers. The return on assets for the three companies, again, we have Starbucks at the top, 2013. Not a year to be worried about. They made business decisions and they were able to keep their numbers high otherwise. Keurig is above Starbucks recently, and since 2010, they've been steadily increasing as well. And here we have Hornbeck. Down here, they don't have a lot of assets. They have assets, but they're a service company, so their return on assets won't be as high as the companies that are actually selling products. The price to earnings ratio for the three companies, we have Keurig here at the top. At 2011, they're well above the other companies, which means that the market saw them improving greatly throughout the years, but you can see here in 2012 it dropped dramatically, but it did continue to increase through 2014. Starbucks has stayed pretty stable throughout the years, which is good because it's stably increasing. So the market does not see Starbucks going anywhere. Here we have Hornbeck. It's a very volatile industry. Once again, a very volatile graph here. The company I would choose 50% of to buy would be Starbucks. You can see across the board that there is a steady increase in all three of the ratios. Return on equity, return on assets, and the price to earnings ratio. The large fluctuation in 2013, it made the numbers go down, but overall the business decision, you can see the numbers were higher than ever after making this decision. So buying 50% of this company, I can be very confident that I would make a great return on this company. So I would buy 50% of Starbucks. Thank you for watching, and I want to say that I'm Bloomberg certified, and I completed this project using the Bloomberg Lab at Southeastern Louisiana University. Thank you.